China's secret weapon for struggling countries, the debt diplomacy strategy. China has a powerful strategy when dealing with struggling countries. It offers easy loans, fast infrastructure development, and economic partnerships, but often with hidden long-term costs. This approach is sometimes called debt trap diplomacy. What is a debt trap? A debt trap happens when a country borrows money, often from a foreign government or financial institution, but struggles to repay it, leading to economic and political consequences. The term is mostly associated with China's Belt and Road Initiative, BRI, where large infrastructure projects are funded with Chinese loans that sometimes lead to heavy debt burdens for borrowing nations. When countries cannot repay their loans, they may be forced to give up control of key infrastructure that includes ports, railways, and power plants. Take on more loans, worsening their financial situation. Make political or economic concessions to the lending country. Real-world examples of the debt trap. Sri Lanka, Hambantota Port. Sri Lanka borrowed $1.1 billion from China to build Hambantota Port, expecting it to boost trade. The port failed to generate enough revenue to repay the loan. The outcome for Sri Lanka? In 2017, Sri Lanka had to lease the port to China for 99 years as part of a debt restructuring deal. Sri Lanka lost control of its strategic national asset. China now has a major foothold in the Indian Ocean, worrying neighboring countries. Zambia, copper mines and Lusaka Airport. Zambia borrowed billions from China for infrastructure, including roads, power plants, and airports. In 2020, Zambia became the first African country to default on its debt during the pandemic. Reports emerged that China may take control of Zambia's key assets. That includes Kenneth Kaunda International Airport in Lusaka, the capital city of Zambia. Zambia's national power company, called ZESCO. Copper mines are Zambia's biggest economic resource. The outcome for Zambia? Zambia is now heavily reliant on China for debt relief and further loans. The country's economic independence is at risk. Pakistan, Wada Port and Power Projects. Pakistan took $62 billion in Chinese loans under the China-Pakistan Economic Corridor (CPEC). Large projects, like Wada Port and coal power plants, were built using Chinese contractors and Chinese labor. Pakistan's debt to China now exceeds $30 billion. In 2022, Pakistan struggled to repay loans, forcing it to seek a bailout from the International Monetary Fund, IMF. The outcome for Pakistan? Rising electricity prices due to expensive Chinese-built power plants. Concerns that China may demand strategic concessions in return for debt restructuring. Kenya, Mombasa Port and Nairobi Railway. Kenya borrowed $5 billion from China to build a railway from Mombasa to Nairobi. The railway failed to generate enough revenue, and Kenya struggled with debt repayments. Leaked documents in 2018 revealed that Mombasa Port was used as collateral for the loan, meaning China could seize it if Kenya defaulted. The outcome for Kenya? Kenya's government is under pressure to increase taxes and raise prices to cover debt payments. The railway project has limited long-term economic benefits. Is South Africa at risk of a debt trap? South Africa has significant trade and investment ties with China, but has not yet fallen into a full debt trap. However, there are concerns. Key Chinese investments in South Africa. China has invested in mining, energy, and infrastructure. Projects like Eskom's coal power plants, Medupi and Kusile, were partly funded by Chinese banks. Debt risks for South Africa. Eskom and Transnet have large debts, and China is a potential lender. More reliance on Chinese loans could create long-term repayment problems. If South Africa struggles with repayments, China could demand economic or political favors. How can South Africa avoid a debt trap? Diversify trade and investment. Strengthen ties with the United States, European countries, and other African nations. Avoid over-reliance on China for infrastructure funding. Increase domestic revenue. Improve tax collection and economic policies to reduce reliance on loans. Boost local industries instead of importing too much from China. Negotiate fair loan terms. Ensure that loan agreements are transparent and avoid using key assets like ports or power stations as collateral. Focus on joint venture partnerships instead of high-interest loans. Strengthen local business and workforce. Ensure Chinese-funded projects use South African workers and suppliers, not just Chinese firms. Invest in local technology and manufacturing to reduce dependence on imports. Final verdict: should South Africa be cautious with China? Yes. China is an important economic partner, but South Africa must negotiate better trade deals to avoid one-sided agreements. Limit excessive borrowing to prevent debt dependency. Maintain strong partnerships with Western nations to balance China's influence. Thanks for watching.